Selecting an index tracker. What's the best way to go about it? So our aim is to give you better performance, and the percentage gains might be small, but on a growing portfolio over time they'll really mount up. And if you select the right index tracker, you'll avoid unnecessary risks lurking in the fact sheets, and I'll reveal these later on in the video. And the key factor isn't what you think. It's not all about fees. So first of all, the considerations are for a global tracker, well, what index to track, because there's several. Do you want an accumulating fund where the dividends are rolled up automatically, or a distributing one? Do you want an exchange traded fund or an open-ended investment company? So if you want to research ETFs, I really like the website justetf.com. They have several guides explaining to you some different world indices. So here's one about MSCI World, and I've got a whole load of ETFs here that track that index. So now I can start selecting the best one. We've got the fund size here, we've got the total expense ratio here, whether it's accumulating or distributing, where the fund's located. That's just a tax dodge, so don't worry about that. And then the replication method, which either samples, so it takes some but not all of the holdings in the index, full replication, all the holdings, but it'll probably cost more. And then the last one is unfunded swap. And what is that? Well, it's basically, it's a derivative, it's a trade with a counterparty, hence the term swap. And the problem is that you get counterparty risk, because if the counterparty goes bankrupt or decides it doesn't want to do the swap anymore, then you are stuck and you might suffer a loss. Not necessarily the loss of all your money, but the fund will kind of be suspended and it will just sort of go nowhere for a while things are trying to get resolved. So for me, it doesn't really pass the sniff test, so avoid unfunded swaps. So as I mentioned before, fees aren't everything. Here are two very similar ETFs. The HSBC one has a 0.1% a year greater fee, so you'd think that its performance would lag over a 3-year period, but actually it comes out, well, very slightly ahead. And then also you have risks in using Amundi instead of HSBC. So with Amundi, it's a smaller ETF, so you might have some liquidity issues, differences in the prices when you buy and sell, that could impact you. The number of market makers for Amundi, well, actually it's only one, whereas this one is actually State Street, but it's got like nearly a dozen market makers. So if there's only one person telling you the price, it's not very competitive and you could get stung. There's also the possibility of provider, this is Amundi in this case, bankruptcy, or them just deciding, well, we don't want to run the ETF anymore because we're not making any money out of it. So the larger, more reputable the ETF provider, the better. So what is key is a thing called the tracking difference, and this is the fund return after the deduction of fees less the index return. So generally this tracking difference will be negative due to, well, fees, not surprisingly, and the need for the ETF to hold a bit of cash to deal with the daily inflows and outflows. However, this tracking difference could be positive if the ETF uses optimized sampling, and that works in your favor. So optimized sampling would be a global tracker saying, well, I can have HSBC, Barclays, NatWest, Lloyd's. Well, I'm not going to have all those banks, I'm just going to pick 2 or 3, and then if the one it decides not to pick doesn't do very well, then it can actually work out in the ETF's favor. And often with optimized sampling, it's ignoring some of the smaller caps, and actually over time small caps don't perform that well, but don't tell small cap investors that. Also, possibly the main thing is income from loaning stock to short sellers. So the ETF will have loads and loads of Apple shares in it. It's not going to sell them in a hurry, and well, even at all. So it could quite easily just loan them out and make some money. So here's an example of an ETF with a positive tracking difference. So it's HMWO from HSBC and here, so 1 year, 3 year, 5 year positive tracking difference. And you can see how it's doing the sampling because it's got 1,380 holdings instead of 3,042. So here's some performance data on a whole load of MSCI World ETFs, and over 3 years HSBC, the one I just mentioned, that's the top one. Not much of a surprise that this one, which has a lot higher fees, is down at the bottom, and also some of the full replication ones aren't doing very well either. Another one to consider is SWLD. This is an accumulating one, whereas the HSBC one was income. So again, we've got a positive difference, then even after the fees, we've still got the positive difference, so that's good. This is another one that I like, MSCI World from iShares, SWDA. A bit more difficult to work out what's going on here, but there is actually a positive difference here as well. So there are some other indexes. I'll let you maybe pause the video and you can read all about it. FTSE All World, it's Vanguard that uses this one. MSCI All Country World Index, known as ACWI. So when you see MSCI World, it's only the developed world, and then this one also includes 24 emerging markets within it. And then there's a one here as well, got even more constituents, as many as 9,000. Wow. And even then, it doesn't include, this one does not include frontier markets such as Vietnam. So yeah, there's lots more companies as well that are out there. So for the Vanguard FTSE Developed World, this has full replication, so it passes the sniff test. Tickers are VEVE or VHVG for the accumulating version, and we do actually have a positive tracking difference. So this one, if you're a Vanguard fan, this one is okay. Here's some other ETFs and what's going on with them, with all the different indices, the ACWI fees, not too bad, and then they're all optimized sampling. But the thing is, when you're looking at whether to have emerging markets or not, since 2009, emerging markets have quite dramatically underperformed. But if we look at the data here, it says since 1987, the end of 87, they've actually outperformed. However, in the 90s and sort of early 2000s, there was some spectacular growth in Korea, which can't really be replicated. There was a lot of urbanization going on in China, which has now been and gone. So we can't expect these trends that were in place in the 90s to continue indefinitely, and the Chinese economy is experiencing mean reversion with the other more developed markets. So as far as I'm concerned, emerging markets are lower returns and higher volatility and higher fees. And then yeah, here it is, we've got some returns here. We've got HMWO and the Vanguard one, and then these are the ones from all of the all world ETFs. Just to look at what's within the FTSE developed index. So this one has Korea, I think MSCI World does not. This one has 598 companies from the USA, so it actually includes companies outside of the S&P 500. And similarly with the UK, it's got 108, so it's got FTSE 100 plus a little bit. So if you decide that actually I want a fund, I don't want an ETF, I recommend you go to the Hargreaves Lansdown website, click on funds, click on fund type and tracker, and then of the 4,000 funds, you're just narrowing it down to those that are trackers, and you don't end up accidentally buying an actively managed fund when you just wanted a basic tracker. So you do that, and then sector, you select global, and then what you'll probably come up with is some pretty good OEICs are Fidelity Index World, which is MSCI World, that's got income or accumulating variance. HSBC FTSE All World, that's another good one. Legal and General International Index Trust, that's okay, it's FTSE World excluding the UK. So I hope you found all this useful. This is a comparison of an accumulating and a distributing ETF on Hargreaves Lansdown, and unfortunately it's just the prices. So the difference here is actually the dividends which are retained within the iShares, but they're paid out within the HSBC. So actually this is not a correct way to measure performance, so do watch out for that. Hope you've enjoyed the video. Give it a like, subscribe to the channel, let me know your thoughts. What's your favorite tracker? What videos would you like to see next?